April 28th, during an interview with Sandy Cutler, CEO of Eaton, whom I think the world of, although the stock took a horrible 6.8% beating today when it reported, I talked about how this company would have great visibility. Sure enough, today it lowered its full year 2008 guidance from a midpoint of $8.05 per share to $7.85 per share, based on lowered expectations of end market growth. Now remember, I came up with an idea of new technology companies, the nation, that dirty smokestack industrial companies, the notion that most people think of as cyclical, meaning their stock should rise or fall with the strength of the economy, were actually secular growers with great visibility, that were solving the world's problems, problems ranging from reducing carbon emissions, increasing energy efficiency, to reducing food spoilage. I thought these companies, and not the video game makers in Silicon Valley or the people who put a lot of songs on the head of a pin, were the new technology companies, because they were innovating in important ways, not just coming up with better and better games to teach your children how to be felons. Now, I recommended 19 stocks as new tech plays, and on average, they've outperformed the S&P 500 by 5.3%. That's good since I started the series. Although you could say it's not saying much, Jim. The S&P 500 is down 13% during that same period. Outperformance matters. I stood up for these stocks even as the street dismissed them as old-fashioned cyclical plays. But now, frankly, look, I play with an open hand. I'm a little worried. I'm a little worried about them after what everyone termed to be Eaton's blow-up today. Eaton, with its hybrid engines, fuel-efficient transmissions, and power quality systems, is the consummate new tech stock. And the consummate new tech stock just got its head lopped off. This is especially worrisome since the company reaffirmed its 2008 guidance not that long ago before cutting it today. Now, maybe they're just being conservative, but it's possible that a global slowdown could hurt many of my new tech stocks. So I need to know if it's right for Eaton to be down 6.8% today. I need to know if the new tech thesis is still sound. The best way to do that is to talk to the man who actually inspired my whole thesis in the first place, Sandy Cutler, the chairman, president, and CEO of Eaton. Mr. Cutler, welcome back to Mad Money.
Thanks, Jim. Good to be back with you today.
Mr. Cutler, I listened to the call. I read the flash notes. Personally, I felt that if you had not been so conservative in your guidance, the stock may not have been so crushed. But it seemed like the analysts believed that in the last few weeks of the quarter, things really deteriorated and therefore had to extrapolate that deterioration and therefore had to be able to say, look, this stock is no longer what we thought it was. Is that a correct characterization given how strong the previous quarter was?
Yeah, obviously we don't feel so, Jim. We came through the second quarter with all-time record revenues up 32%, our profits up 35%, actually outperforming our expectations when you correct for the one-time tax item and the earlier moving on our financing by some 10 cents. We think that's really extraordinary performance in a quarter in which we've seen incredible turmoil in terms of what's happened with the 40% increase in fuel prices and then this ongoing drumbeat of concern about banking and credit markets. Our whole change in terms of the long-term look, that's the full-year guidance, has to do with the fact that we think sometime during the second quarter, as fuel went up about 40%, we saw an impact upon consumers and industrial customers where they're looking at those higher fuel prices. And I think most economists are talking about global economic growth being reduced by about 1%. That's what we did today, is we said that we thought global economic growth would come down by about 1%. But in spite of that, our guidance full year would only come down by 2.5%. So the thesis is in place. We have a strong, diversified, balanced business, and we reiterated our feeling that we can again grow earnings next year 15 to 20%. So we think a little overreaction to a very minor tuning, but the basic thesis that the company's breadth and overall confidence in terms of international and U.S. balance is still very much in place.
Mr. Cutler, I'm glad you brought up the overreaction issue because my audience is not just the hedge funds. It's people at home who know that Eaton is a great American company. When you were sitting around with your people today, did anyone say, now how the heck can our stock be down 10% when we basically did an inline quarter and guided down maybe no more than a nickel in reality? I mean, do you think that we're nuts?
Well, I think what we've been seeing, Jim, and it's not just an Eaton story, but if we watch the financial markets over the last several weeks and months, there seems to be such a nervousness and a concern that I would characterize it, and I think many people have, as a trading-driven market versus a value investing market. Now, that means there are enormous opportunities for value investors on these points of weakness, and we think, obviously, with a 20-cent reduction in our full-year guidance on the basis of $8.05, so that's 2.5%, that's a pretty immaterial change to cause trading in over 10 million shares, well over 6% of our total outstanding number of shares, and obviously the kind of percentage drop today.
But you did, I have to admit, and this is where I was concerned, I was a tad disconcerted when you talked about you've made this very big move into the rest of the world, very big move in Europe, and yet you were quite detailed about the places where Europe has suddenly slowed since the acquisitions closed, making some of us feel, holy cow, did Eaton get hurt by those acquisitions?
No, absolutely not. These three large acquisitions that we've talked about, one that we did last November, one in February, and one in April, are actually outperforming our expectations. I think a theme that we've all heard around investing markets in the last several months is it appears that Europe is slowing down. And what we said today is, yes, we think it is. It's still positive growth. It has been growing at faster than secular rates historically. And the Eastern Europe and Russia are still growing at very much premium areas. So we went to some length today to indicate those three acquisitions are actually performing better on the top line and the bottom line than we'd expected. So that thesis is still very much in place.
One last question. People said, oh, wait a second, he's got commercial aerospace, he's got commercial construction, he's got trucks, that all these markets are just going to just blowing to smithereens. You're not seeing that either, are you?
Absolutely not. Our global electrical business, we think, may grow at 5% versus 5.5%. I'd say that's a tuning. Right. We actually raised our guidance on our hydraulics business. We continue to be very bullish on, as you have been also, on hybrid vehicles. So no, we don't see the world as imploding. We're saying we think it's just growing slower, and it's prudent in that environment for companies to think through their investments. That's obviously what we're doing. But still, we'll have all-time record revenues, all-time record profits this year, and we think that will be true again in 2009.
Sandy Cutler, Chairman, President, and CEO of Eaton, thank you so much for coming on Mad Money. Appreciate it.
Thanks, Jim. Appreciate the coverage.
All right, guys, now understand, we are in a terrible bear market where somebody can miss by a couple of pennies, then guide down by 20 cents on an $8 earnings number. Here's what you do if you own Eaton. Maybe someone downgrades it tomorrow because they're so frightened. Buy a little more. This company is a great American company that's here to stay. But I see the overreaction. It's the market that's doing it, not Eaton. He's being honest. The market is being crazy. I like Eaton. I'm standing by it. Stay with Cramer.